When investing in the stock market, two of the most common options are mutual funds and index funds. While both allow investors to diversify their portfolios, they have key differences in management style, cost, and risk. Understanding their advantages and disadvantages can help you choose the right investment strategy for your goals. What are mutual funds? A mutual fund is a professionally managed investment that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. These funds can be either actively managed, where fund managers try to outperform the market, or passively managed, following an index. Advantages of mutual funds: professional management. Fund managers handle investment decisions, analyzing stocks and adjusting the portfolio to maximize returns. Diversification. Mutual funds invest in a wide range of securities, reducing the risk associated with holding individual stocks. Variety of options. Investors can choose from equity funds, bond funds, sector-specific funds, and more. Accessibility. Many mutual funds allow investors to start with a small initial investment. Potential for higher returns. Actively managed mutual funds have the potential to outperform the market if the fund manager makes good investment decisions. Disadvantages of mutual funds: high fees. Actively managed funds often come with high expense ratios and management fees, which can eat into profits. Underperformance risk. Many actively managed funds fail to beat the market, making the higher fees unjustified. Less transparency. Investors may not always know the fund's holdings in real time. Capital gains taxes. Mutual funds often generate taxable capital gains, even if the investor doesn't sell shares. What are index funds? An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific market index, such as the S&P 500, Dow Jones, or Nasdaq 100. Unlike actively managed mutual funds, index funds are passively managed, meaning they simply follow the performance of a chosen index. Advantages of index funds: low fees. Since they are passively managed, index funds have much lower expense ratios than actively managed mutual funds. Market performance. Index funds generally perform in line with the market, making them a reliable choice for long-term investors. Diversification. By tracking an index, investors gain exposure to a broad range of stocks with minimal effort. Transparency. Investors always know what stocks an index fund holds. Tax efficiency. Index funds experience fewer taxable events compared to actively managed mutual funds. Disadvantages of index funds: limited growth potential. Since index funds follow the market, they can't outperform it like some actively managed mutual funds might. No active adjustments. In a bear market, an index fund continues to hold all stocks in the index, even underperforming ones. Lack of flexibility. Investors cannot customize their holdings based on personal preferences or market trends. Which is better for you? If you prefer a hands-off, low-cost, and steady approach, index funds are the best choice. If you want the potential for higher returns and professional management, mutual funds may be a better fit, though they come with higher risks and fees. For a balanced portfolio, some investors use a mix of both, combining the stability of index funds with the potential upside of actively managed mutual funds. Both mutual funds and index funds offer great opportunities for long-term investing. The choice depends on your risk tolerance, investment goals, and preference for active versus passive management. While mutual funds offer potential market-beating returns, index funds provide low-cost, predictable growth, making them a favorite for many long-term investors.